A&R has a reputation for avoiding the excesses of the buyout business. I'd like to know, what do you see as today's excesses and how are you avoiding them?
Yeah. Dave, you want to take that?
We think it's important to be focused on what you know versus what you don't know. Don't follow trends just because at a moment in time people think that's where you want to invest. For almost 40 years now, we've only focused on businesses that we understand well, have operating partners in-house who know how to manage those businesses better, and we're going to keep sticking to that.
So what then runs the risk of being overly fashionable today?
Well, I don't know. I think it is changing. I think fashions come in and go out, and I think it's difficult to. I mean, we had the big tech. The big tech fashion, and you could argue at the luxury sector that was sort of strengthening. What we try to do is we're very focused on how we invest, and actually we're not a buyout shop that needs to do lots of deals. We do 3 to 5 deals a year. And we do it in such a way where we have experience and expertise. We do not invest in areas where we don't have that expertise, both on the financial side and on the operating side, which is very much the way we operate.
One of the things that is consistently fashionable in private equity is leverage. How much leverage do you feel comfortable putting on a transaction today? How many turns?
In truth, it varies on the transaction and the company. As you know, different companies and different industries have very different cash flow characteristics, different investment characteristics. So we've done deals in businesses in which we've had a traditional highly leveraged package, 5-6 times leverage, but there have been other businesses that we've invested in which have been much lower because the company and or the deal didn't accommodate.
But is your inclination today to be more or less levered than you might have been in the past?
Without a doubt, the inclination is slightly less levered today. But importantly, it is the amount of leverage is one thing, but also the terms of that leverage.
How easy is it to get? We hear that, we can see what's happening in the high yield market. We hear that bank lending is beginning to freeze up, particularly on the leverage side. What do you see?
Well, that's certainly the case in the U.S. at the moment. And that mostly has to do with the sort of significant reduction in fund flows coming in because of oil and gas revenues having come down significantly. Europe is still open, and David, I think you can comment on that.
Yeah, we could still get some leverage in Europe, but it's a little tighter than it was.
I mean, some firms, as you know, have had trouble.
Indeed.
Right, they've had to self-finance the credit side of the transaction.
But if you talk to some bankers, they will tell you that actually they've got some deals in the States that they can't, offload. And they're going to come over to Europe because they think there is a market for certain.
Oh, there's appetite among European investors
for certain types of deals. That's at least some of the bankers have been telling us.
Here's the thing. We live in a world of lower returns, right? So long as the benchmark lending rate is a 0.25 percentage point, and in Europe it's effectively negative. It's harder to generate returns over time. Does that make buying at the right price much more important?
I think we've learned that lesson over the years. You buy it right, makes it a lot easier on exit. And if you overpay, and at times, people do stretch. They think, well, this is strategic. This is really going to be something that makes an awful lot of sense. Let's pay that bit more. But that bit more causes you to do an awful lot of work in order to get the sort of returns that you're trying to get.
Well, you're still investing a fund you raised in 2013, and we haven't really seen a lot of public market leverage buyouts over the past couple of years. With the decline in stock prices and the reduction in valuations, is that going to get easier?
We definitely think that that's a trend that will grow. A lot of bankers are freshening up their analysis on what are the right premiums you need and what multiples. And frankly, for us, who are very industry focused, we follow lots of companies in our specific industries, both public and private.
What's attractive by industry right now? Where do you feel you want to commit capital?
In Europe, we continue to like the European consumer. We think it's early days still in a European consumer recovery, supported by low interest rates, low energy prices. They have more money in their pocket, for example.